Welcome, ladies and gentlemen, to is it the second season, Nick, we have now? A little
Season
humble
2.
brag of the Grey Market Talk.
Season 2 it is.
Unbelievable. Huh? So I've counted. We had 33 shows, including the last one last year. And I'm planning this year on doing everything between this one and let's see how much fun we have to keep it on. I hope that we'll find your agreement. We already have to skip one in 2 weeks' time because we will both be live in a seminar.
Indeed.
So what you're going to do, was it 3 weeks' time? 2 weeks' time. 2 weeks' time. Anyway, so I thought, how are we going to set the stage here today? Nick, first of all, obviously I said it already off the air. I wish you a very successful year 2024. All our viewers, I wish you a very successful, healthy, and happy 2024. And today we keep it a bit shorter. I've only got a couple of few quite interesting slides simply to set the tone for what we might to expect. And as you've done probably like we did between Christmas and New Year, you listen to a lot of podcasts. And that's very, very interesting because some guys see doom pending. Yeah, I used to be of that camp, not so much anymore, but a little bit still. And other guys say, yeah, it's going to be a roaring party into the first 3 months. And that brings me to the point that I should share my first slide. If I find the share screen button, there we go. So, Nick, you can see it?
Can indeed.
So, Grey Market Talk and setting the mood for 2024. We all know these seasonalities, and I'd like the statistics, especially if you look at the first line, the S&P 500 since 1945, and what the pundit has done. Aren't you forgotten the name where Murat, that's from his presentation he will show on Wednesday, got this from. But I found it very interesting because it shows you should be long from November till April, and you should not, let's not say short, but you should not be long from May till October. Nick, does that match your expectation for what we're going to see in 2024?
Well, 2024. Here you've got November. You should have been long between November and December 23. We might see a little bit of a kind of a sideways choppy kind of thing in the first quarter or so. I think the fun starts towards the second quarter, third quarter of this year. So I don't think that the first quarter is going to be particularly brilliant one, but I still believe ultimately that we'll see much higher equity prices before the end of the year.
So you're a statistical contrarian in this case.
This time I think I probably am. Thanks for reminding me. I'm going again against the grain here.
Well, you were right. The whole of 2023, it seemed to have worked, and it's just the whole Bayesian approach we are doing in our research, how we are trading. It's always these are what we call the priors, the statistical hard cold facts. What you would say, okay, what we're going to do, and I'm pinging that on to one of my fellow quants to say, does everybody actually has ever made a statistical research of comparing different investment styles? What I just put into the introduction. Yes, we want to be long, then we want to be long and want to be flat in the second part of this scenario, or we want to be short, or we want to be short and not long at all, and simply put them next to each other to get some results. I'm pretty sure it's already out there because that's the kind of stuff people do who love their Excel sheets, but I couldn't find them on a short notice, so I thought we'll give it a closer look again. Because I just mentioned the podcast I was listening to between between Christmas and New Year. And one of the guys I really think highly about is Darius Dale from Macro 42. And we mentioned him on this podcast before, when he was actually saying the party is always the best just before the cops arrive. And what he said is the cops haven't arrived yet. So his models are telling him he is as bullish as he possibly could be for the first 3 months of 2024. And I thought, why is that? Where have I got we'll come to that in a slide a little bit later, my bear market thoughts coming from all the time. And you know what I was stolen off, Nick? Simply the recession. The recession didn't happen. The yield curve indicated we should have had a recession. And why was that? So I'm quickly slipping forward a little bit, and I thought to myself, let's put the, how do you call it, aluminium hat on, tinfoil hat, and say, how would I have been satisfied with my analysis? And what we see here, it's a chart from Bloomberg. I ripped off the Substack he has out there. It's a Bloomberg chart simply showing the real GDP in the US. And what you can see here, the first 2 quarters of 22 were negative. But the Bureau of, what's the name of the guys who are determining ex post whether we had a recession or not?
Oh,
The Bureau of Economic Research or something like that?
Is it BEA, Bureau of Economic Analysis?
I think everybody knows who we're talking about.
Yes, indeed.
And then I thought, ooh, if I look at that, they've stolen the recession from me because they said this wasn't one. We had, in our definition, on the old definition, 2 quarters with negative growth is a recession in the books already. When did the yield curve invert? Just before that. When did we see a temporary high in the stock market? Just before that. If they would have granted me and say, yeah, that was a recession, Mr. Wegener, then I would have said, okay, fine, I had my recession. The yield curve worked. The stock market did what it always does. It rallies right before it turns around when we're going into recession. Employment numbers were down. All the data bits you usually need for recession were there. The market had a correction. But in the official statistics, when you put in your charts always show me the gray lines for the recessions, it always works. But they miss out these 2 quarters. If that would have been in there and counted as an official recession, I would have said the whole time, yeah, we're late cycle.
Yeah, I get it. I get it. Makes sense. Satisfies, but it would have allowed you to tick the box and move on, and maybe you'd have got bullish a little bit earlier because you've got the recession behind you.
Absolutely, because I ran into this psychological framework. Yes,
Still waiting for it.
The quad model told us what to do, and then it said, yeah, we have growth and inflation is coming down, and we invested according to what you should do, but I was never feeling comfortable with it. Maybe that's the point how you make money. It has to hurt because you do what the data tells you, but it didn't fit in with the scenario, where is my recession? And then looking at this chart, it came to me and said, yeah, we had the recession. They just took it away from us. They said, no, it isn't one. Go away. And that made me nervous. So anyway, I that's why I put this slide to the front when we look at this data, because it would actually calm one down in this period and say, okay, Dario says the next 3 months would be fantastic. The historical data, which I'm sure also go into his model, will satisfy that. We have seen employment figures last week. They were fantastic, weren't they, Nic?
I don't think so. I actually think these numbers are always a little bit misleading. 200,000 non-farm payrolls is there or thereabouts. It's not really a rocket market. I said towards the end of last year that that if there was one part of the economy I'm probably most worried about is the employment sector, for the reason that when we discussed this, Jeff Gundlach's moving average, this over the unemployment rate, there was a cross in my view, and therefore I started to look at the unemployment thing a little bit closer to what I had done in the past. And I don't think those numbers will rocket. They're kind of okay, but in an economy which is theoretically not in recession, with the government throwing as much money as it possibly can into the economy, with artificial intelligence, with all of this stuff, I don't think they're all great numbers, to be honest with you. But so I still think that the employment is part of the economy where I'm probably most worried about. So that's what makes the market, I guess. I didn't see anything positive.
That reminds me of, it's been quoted many times, one of the line of Alan Shepard, famous American astronaut, when he was asked what is a good landing. And he said, well, a good landing, let's substitute good for soft landing, is a landing you walk away from.
Well, indeed. I mean, the economy is okay, right? It's not brilliant, but it's okay. And look what you have to do to get an okay economy. you have to pump as much energy as you possibly can. And, they're certainly throwing as much oil as they can into the market and producing as much gas as they can. But so you've got enough energy, and you have to have a government that's willing to have huge deficits. And then you've got an okay economy.
That was also one of the thoughts, huge deficit, you mentioned it. And we discussed that obviously also before, that the consumer in the US has another 3 months of powder dry to spend into the new year. And also one of the things distracted me when I moved back to Germany and the kids went to school here in Germany. I became active in the Parent Teachers Association. And that was obviously the tail end of the financial recession, and all governments pumped money into schools and you name it. Yeah. Money was pleasant. It was plenty and they could do stuff with it. And I just remembered it took them over 18, 24 months actually to spend all the dosh that came into the systems. And how much money did they spend in their, how did they call it, the Inflation Reduction Act? Over 750 billion, is that correct?
Well, I don't know what the number was, but these are
Was huge
sums of money, and they were good, right? And this sum of money didn't just get used for American, companies. It also attracted a lot of European companies to go and get some of the, these benefits from this policy. So, I must say, say what you want about the, the Americans, but they know how to run a business, and they're still the best, as we say, economic market out there in the Western world.
Yeah, I agree with you. It's this, all this money is sloshing through the system and it hasn't hit the market yet. It's filtering in slowly. And we established that before, that the whole growth in the United States was actually government spending. It was the fiscal impulse. If you look at the increase in debt, that was pretty much what the GDP showed you on a corrected basis. And so, yeah, if this is going on, I'm then contrarian to you. I'm going with the historic data and the priors and think the first 3 months, let's see whether we have a party or we will not have a party. And here's, again, question. I've heard this stealth liquidity talk quite a bit and I never understood it. Nic, what we have here on the chart is the Fed keeps liquidity conditions stable to increasing. QE light. What's going on there?
Well, I don't know this, Steno. Okay, I don't know where how he's calculating it, but I guess this is just the assumption or the calculation that the Fed are going to keep bank reserves at a sort of a certain minimum level, and as a result of that, they this kind of tells you how much liquidity they need to keep in the system in order to maintain the level of bank reserves. And I think I have to sort of understand where he gets those numbers from. But the bottom line, I think he's trying to say here, Fed keeps liquidity stable to increasing. That's exactly right. So he's effectively saying the Fed understand liquidity. They want to make sure that there is ample liquidity in the system. They want to make sure that the banks have enough reserves. And therefore, what is the thing? What is it that they have to do in order to maintain that? In order to keep the system going, and he's calculated it, so good luck, and is effectively saying, yes, there's going to be more liquidity coming in.
This goes into
we've said that for a while, that that's what they'll do.
That's if you look at bond markets have now priced in 6 rate cuts in 24. There are 8 meetings, Fed meetings. So one is when next week or the week after. And I can't think that they will already cut rates in January. So the bond market in its exuberant, let's use that word from Alan Greenspan, exuberant estimates says we'll see a rate cut in pretty much every Fed meeting for the whole of 24. If that would be the case, are they terrified? Do they know more? Is there stress in the system somewhere?
No, again, coming back to what we spoke about last year, almost in our first episode, as it were, one of the comments I made was where does inflation come from? Inflation comes from excess money supply. What happens with money supply over time, if you're not adding to that money supply, then money supply goes down. So therefore, inflation will come down with or without the Fed, right? And as inflation has come down, people still say it's sticky. It may well be sticky, but it has come down to normal levels. So the question is, what's the real rate of interest that the Fed want to achieve? And perhaps they're saying, well, if we see inflation continue to come down, there's no reason to be excessively tightening, because that's how they tick. They believe interest rates are the solution to solving the inflation problem. So we have to play their game. So they will see inflation coming down and say, we don't need to be so aggressive, so let's be less aggressive. And it's nothing to do with the economy. It's all to do with the direction of inflation. And in my language, the direction of inflation is determined by money supply, and that has come down dramatically. There is still a lot of money sloshing around in the system. That's where the sticky inflation comes in. But that will come out of the economy over time.
Because putting the tinfoil hat on again, you've probably seen that as well. I got these messages from my students. They looked at the bond market, and there were these intraday spikes. Suddenly saw the 10-year spiking through the roof. You at the short end, you saw spikes through the roof, and everybody. The conversation was: is that just data? Faulty data in charting programs, or is there something going on? Is somebody blowing up? When you hear these conversations, what's your take as a market professional with 75 years of experience?
At least 75 years. Well, I'm sure that let's assume that the data is correct. I think what we're saying is that over that period of time, liquidity was not perfect, right? And I say now a different type of liquidity. I'm talking about the liquidity. Can you buy something when you want to buy it? Can you sell something when you want to sell it? So that kind of liquidity, not Fed liquidity. So I think over the past few weeks, there hasn't been that much liquidity. And you see that also in the MOVE index, the bond volatility index has been heading higher. So I think there's been a lack of market liquidity, and for that reason, there's been some big trades want to go through. Yeah, I mean, people have been wrong. People want to put on new trades. There's just not been enough there to do it, I think.
I agree. So setting the mood for 24, that was one of the slides you've seen as well. Because whoever is posting it, and a lot of people are reposting it, apparently it's the most important slide for 2024. It's the correlation between bonds and stocks on the long term. What we can see here is, obviously, we used to have a negative correlation between bonds and stocks, which is a good scenario, and then we turned positive. What does that mean? It simply means if bonds go up, stocks go up, and if bonds go down, stocks go down. In the positive correlation scenario, and that's what actually screwed up the classical 60-40 portfolio over the last year in this massive move down. So, getting the glass ball or the crystal ball out, this correlation, Nic. What do you think about the relationship for, let's not go far too long in the future, but for the next year? Will we see negative or positive correlation between bond markets and equity markets again?
This is a real interesting question. And I mean, you referred to that negative correlation as being a good thing. I'm not so sure it's a good thing. I think, the only reason you have negative correlation is, why do you have low interest rates at the end of the day? You have low interest rates because, the economy isn't so great. So having high interest rates in a sort of a positive economic environment, sounds like a good thing. So having high interest rates and an equity market that's doing really well, it, doesn't seem such a bad thing to me. It suggests that, you can buy anything and you'll make money. The problem comes when they both go down. Now, we are in a situation, in my view, and we talked about this also at length in the past, where we effectively say that the governments, because of the debt situation, cannot allow things to fall apart. and they have to maintain the orderly bond market. So they can't allow a bond market crash. They can't allow an equity market crash because, a lot of tax receipts are driven by equity markets. So at the end of the day, they have to keep both things going reasonably in an orderly fashion. Now, whether one goes up one day and the other one goes up the other day, I don't know. Here's my thought on sort of the individual pieces of that puzzle. And there's no answer to it other than ultimately still equity is up, right? So you think your risk asset is up, but what about your bond market? And your bond market, with the humongous amounts that the government have to issue over the next couple of years, over the next 10 years, without the support of the international community, tells you that it's not going to be easy going to go and fund your debt. And so who's going to fund your debt? Well, it's going to be the, domestically funded. It's going to be domestically funded, of course, like everything else. If you want to borrow money, you have to sort of incentivize someone. So you might think over time, interest rates will continue to edge higher. We'll have this interim period right now where rates are going down. But I think over time, rates will find higher levels, not lower levels. And so if I like the equity market, and I'm saying that in the short term, you're going to see, perhaps bond yields maybe find their lows somewhere in the, with a 3.5 handle there or thereabouts. But over time, yields are going to edge higher, 5.5%, 6%. But I like equities. That just says to me that we're back in a situation where equities are going to go up, but bonds aren't going to be an exciting investment. I've heard a lot of talk about, well, you know what? You get paid 5% for being in bonds. Yeah, but if bonds are going to lose value over time, your 5% carry is going to be eaten away with a negative price action on the bond as yields sort of edge higher from where they are now. We're down at 4%. Yeah, that's quite low. And if they go to 3.5%, you'll make money initially, but when yields start to go up, you'll lose money on the bonds. So this correlation bit it really does depend on, are you at the phase where yields are going to go down to 3.5% before they go up? And once they start to go up, I think they'll be going up because the Fed are going to be, or the Treasury are going to be borrowing so much money, yields will be going up, people will be expecting higher interest rates. But in the background, the economy is still going okay, and the equity market's going up. So you'll have a period of negative correlation, you have a period of positive correlation. As an investor, you need to be nimble. I don't think it's a buy and hold market.
That's difficult, the nimble bit, Nic.
I know, but I actually, it's really tough to say to somebody, go and put some money into this strategy, 60-40, 100-0, 0-100, bonds, equities, a mixture of both, and say, don't worry, you'll be fine. I actually think we're in an environment where it's the bond thing that is probably for the next couple of years, the bond thing that's going to be the most difficult element to play. I don't think it's a safe thing just to say, go and buy bonds, because I think there'll be a time when you do want to buy bonds, and then there'll be a time when you want to get out of these things just like before.
Well, maybe let me close or almost close with a beautiful chart for everybody who doesn't want to be nimble. We already had this, and from, what is it, Visual Economist or something. I love to show this chart because what does everybody see there? It's a bloody bell curve. It's the returns of the S&P over 150 years. Yeah? So, yeah, give me good old mean reversion. Where are we in the whole cycle? I have a mean I can establish. I have a standard deviation / volatility I can establish. And where are we now? We are just about here between the 20 and 30 bracket, 25% in 2022. In the long run, it will all come down to establishing a bell curve. So Mr. Farmer was right, in the long term. Markets are random because that is what we are seeing here.
Possibly. I still say you need to pick your years, and you need to, because there's a big difference between, one column and another column. And I think we've seen a tendency for people to just continue to invest. But I think the outlook over the next, let's just say 10 years, it's crystal ball, 5 years, I think we're going to have a first few years, really good years. And then I think all hell is going to get, fall apart. So that's a different story. We'll worry about that later. And we've got plenty of time in the series too to talk about that. But for the next few years, I think we're okay.
All right, because all things could fall apart. There's one chart I stumbled across, and I thought that was actually also very interesting. ChatGPT, when we have the Magnificent Seven, where could the big hit in reallocation of investments be coming from? And I looked at this, and what you can see on the left side is simply the adoption rate for ChatGPT right at the beginning, which obviously explains a lot why people went completely batshit crazy about AI stocks and what you could do with it. And fantastic, yes, till we see April 23, and then everybody, including our good selves, had it on their computer and was using it and playing with it and realized, yeah, it's pretty cool. It's a nifty tool, but it is not like the internet, which really changed people's lives. And we went through that period. You can remember the good old days when we were sending these paper envelopes with 100 names through the offices. You had a message to somebody in back office, mid office, or in management. So you wrote their name on it, their department number. And 7 times a day, our colleagues from the mail office came through, collected them, and distributed them through the house. Okay, suddenly that went out of the window, and we started sending emails around, and that made life easier until people started CCing everybody into a message, and you started the day with 400 emails in your inbox because you were CC'd into pretty much everything that was going on in the firm. However, we started ordering books. Our life became easier. The adoption rate went through the roof worldwide, and that's what you can see. I ripped that from Wikipedia, so it must be true. On the right, the adoption rate for the internet. So if I look at ChatGPT on the left and say, I would have expected further growth, not already building out a plateau so close to when the hype started. That made me a bit, thoughtful about this whole hype we are celebrating at the moment. And in my view, that could actually indicate all these guys who were invested last year in the Magnificent Seven and had fantastic returns might think, okay, I made more money than I could possibly fathom. So let's take a little bit of these chips, and yes, I stay invested, but I reduce it a little bit, I skim it down a bit, I put some hedges on, and I start stock picking again. So the narrative driving this market into this stratospheric development with only 7 stocks could change dramatically over the next 3 months, even when people start realizing, oh, we've seen the tops. Well, let's start selling my Apples, my Microsofts, my Facebooks, my Nvidia, my everything. Too pessimistic. Well, I want to see this bloody headset coming out. I'm already geared up. I just for the seminar, I bought myself a new MacBook Pro. Very pleased with it for one reason. The last time I bought a notebook, I was considering Apple because I'm using my desktop as Apple, and I'm very happy with it. But this was the time Apple provided their Pro books without any plugins. Yeah, we want to have everything in the cloud. And I said, I want to have a bloody HDMI slot. Yeah? I need to connect to a beamer. I need some USB ports. No, they didn't offer that, so I went for an Office notebook, a Microsoft notebook, and this time I went back to Apple again. I thought, okay, fine. However, Apple hasn't really increased or has shrinking revenues for the last couple of quarters already.
So everything you just said there about investors taking a second look at the Magnificent Seven, perhaps a disappointing overhype maybe initially for this AI and leaving everything else behind. we spoke about that also late last year, where I basically said, look, if I was Tim Cook, I'd be selling Apple stock and buying small caps. And sure enough, okay, it did take a while for me to to live that idea. That's exactly what we're seeing. And actually, there is a rotation right now out of growth into small caps. Probably Murat's already talking about it, or
Yeah,
perhaps
absolutely.
we
You
should
see that.
talk.
You see that on Wednesday.
Okay, well,
The data
that,
from the relative rotation graph, and it shows very, very nicely what is happening there. Exactly what you just said, Nick.
that's I think exactly the point, and that's why I kind of get the feeling the first quarter is going to be a little bit shaky. I mean, the Friday before the new year, I put a short on. I actually sold all of my sort of long calls, or call spreads and butterflies and stuff and whatever, and then I actually put on a short trade. I haven't had a short trade for donkey's years, right? And I actually got nervous this Friday and closed it because, I mean, it made enough money. But the point being, I actually think this could be the start of, and if it's not at this level, it might be 50 points higher in the S&P. But I actually think what we're seeing, this whole rotation business, may well lead to a little bit of volatility in the market when people start to see Apple and Microsoft and so on come down off the highs. And you're seeing people actually taking money out the market. You look at these McClellan oscillator. My interpretation of that is money's coming out of the market right now. And that's quite a negative thing. And I think that's sort of part of this rotation and part of people being nervous and just taking money off the table, as you say, for people who've just been long of the 7 and just want to be long of the 7. And then they say, we get out. They're not interested in buying small caps or anything. They say, okay, I made my money, get out. So I think there is some of that right now. And that's why I feel a little bit more cautious about the market. And the other thing, of course, about the market at this level is that, again, we spoke about this, when the market sort of went down to this 4,100, held.
Yeah.
And then we said, well, where's it going now? And then it went to like zoink, and it looked like a straight line. I said, well, for an Elliott wave guy, it's pretty tough not to have any sort of squiggle in between and count a wave. And then I said, well, look, there is a gap there. And that gap is a wave 3 of 3. And if we kind of hypothesize that the wave 3 of 3 is the center of a wave pattern, then where does this market go? And I think I calculated on air, as it were, that this would go to around 4,800. I just measured the difference, said, okay, if the gap's the middle, it's about 4,800 there or thereabouts. I can't remember exactly what I said. And it kind of reached that. And I did the sort of calculation afterwards, and it reached that level. So I thought, well, you're kind of at the target right now for this particular wave. I don't think we're long-term bearish. I just think it's a correction. And I think this part of this thing is exactly the story you've just put forward about people getting out of, being disappointed in some of the Magnificent Seven, and maybe realizing that the AI is, at least at this stage, perhaps overhyped. It will come back in fashion later when it's a bit more mature, right? So, I think that's probably right.
No. But the one point out, the main point I get out of this conversation. Yes, there are two ways. We have the priors, which say, yeah, fine, let's go party first quarter. Then is your point, which has actually been confirmed by what, if you want to watch the Murat show, Murat's Monthly on Wednesday, where we see exactly what you just pointed out now, that we see this rotation going into smaller caps in. The one thing I'm also mentioning that on Murat and my show, I want to mention it here again, is volatility. It's absolutely awesome. You see the S&P, that's why I'm looking to the left. I have the chart here. We have taken out the all-time high. Now we are correcting, and the market is at this level where it could either completely overshoot, or we're going back to the levels of 4,100, having a look what's happening there. However, straddles are priced, or were priced, extremely cheap at levels of 12. You could open them. And I call that, again, Mr. Gundlach, thank you very much, the way of thinking, the Gundlach trade. In a year's time, will we be in 12 months' time at the level we are now? Well, maybe. What will happen in the meantime? In the meantime, there will be a lot of noise going through the markets, and this noise will come with volatility. So the question then would be to say, fine, either volatility goes up, I will make money on my straddle, yeah? Even if we go back to normal levels. Normal level in this case would be the median is over 15, yeah? Where 50% are below, 50% are above, and the long-term average is at around 19. Your time value, you don't lose on longer term options right at the beginning. Yeah? So you are very sensitive to the volatility, our Vega we have in there. I think this is a trade where you actually could make decent money while you sleep well. And if you scalp your gammas the right way, even if you bleed, you get overcompensated for what you can do there. And that's one of the things, obviously, I'm going to go into further detail when the final black, when we have our seminar in 2 weeks' time about the magic you can do there. And these are the opportunities, even when you are a fan of the bell curve on random markets like I am, which give you a chance to set up nice trades without having too much exposure to the camp of bullish or bearish in there. So these were my final 5 cents of wisdom in what to do in these markets. Nic, I thank you very much. I think we gave it a good start, also a little bit shorter. I don't know how long. Actually, the plan was to do it even shorter, but hey, once we start talking, it always happens like that. So let me give you the chance to have the last words as always.
No. That was brilliant though with the straddles. So I'm looking forward to the next chat. Certainly looking forward to the course.
Thank you very much. Thank you for watching us. Share us, like us, leave a comment. We will always go back to the comments. And well, so far, we've kept our promises, and we will see you in a week's time. Thank you very much, Nic. Bye-bye.
See you. Bye-bye.